Aloha, everyone. Welcome back to the show. Super grateful to have you join us. And I'm even more grateful to have my guest on today. His name is Michael Episcope. Welcome to the show, Michael.
Thank you, Pili, for having me.
Super excited. So everyone, Michael is principal of Origin Investment, co-chairs the investment committee and oversees investor relations, marketing, and company operations. Origin is in the top 1%. Again, Origin is in the top 1% of private real estate North America focused fund managers by Preqin. Michael brings 25 years of investment and risk management experience to the company and believes that calculated risk-taking in inefficient markets is the key to building wealth. We'll get back to that. He regularly contributes to Forbes, looks for him, Forbes Entrepreneur, and Huff Post, as well as frequently speaks on real estate investment panels and podcasts. Welcome to the show again, Michael.
Thank you. Great. And I want to clarify, we're no longer in the top 1%. So we've actually stopped saying that. I think we got kicked to 2%, but that was done by Preqin, which is a third-party rating system. And they look at the returns of more than 2,000 managers across the globe. So rather than go through this 1, 2, 3%, now we just say we're top decile because we're confident that we're going to stay there. But I just wanted to clarify that if you.
Well, thank you for the clarification. Instead of 1%, he's in the top and his company is in the top 2% instead. That makes a huge difference. That doesn't tell me anything else, but you are awesome. So let's start from the beginning, Michael. Why real estate? Why did you get into it? And let's go from there.
Yeah, great question. And I'll take you back because I sort of have a non-traditional route into real estate. And my first career was as a commodities trader. And I started down at the Chicago Mercantile Exchange when I was 19 years old. I was actually in school. I got a summer job. I loved it. I'm here in Chicago. I'm still here today. And Chicago is the commodities trading capital of the world. And this is where the Chicago Mercantile Exchange is, the Chicago Board of Trade, the Options Exchange. So anybody who has gone to college here, has touched it in one way or the other. And I went down there and just loved it. And I decided that that's where I really wanted to stay. I'd always loved to work. So I pushed my classes to night, burned the candle at both ends. And I was a clerk. I was at the lowest level you could possibly be. I think I was making $363 a week. I was running orders. I was meeting people, working my way up. And I did that for about 6 years. And then I ended up getting hired as a broker. I did that for a couple of years, decided I didn't really love it. I wasn't passionate about it. And I really wanted to try my hand at trading. So through some relationships that I had made down there, I had got an opportunity and I was pretty good at it. So I started there in 1997, January of 97. And funny story, I'd actually broken my shoulder about 3 weeks before in a snowboarding accident. So I started very first day of my dream job. I have a sling on my shoulder, just had surgery. I was on painkillers and standing there in the pit and, everybody's pushing one another. I'm sure you've seen pictures of that, but that's how my career started off. But I can, it was uphill from there. I'll just say that, and did really well. Ended up going off on my own 2 years later, backed myself, my own capital, and just hit it hard for about the next 7 or 8 years. So I had a 9-year trading career where I dug in, and that's where I built my wealth. And when I started trading, I always jokingly, I say to my boss, who I still keep in touch with today, but I'm like, thank God you didn't pay me more money because I would have never gone and been a trader. And so, it worked out for the best. I ended up, just throughout that, I think 9 years later, I punched out of that business in 2005 for a couple of reasons. Number one, my risk profile had changed. And when I started in the business, I was single. I didn't really have any net worth. And I had nothing to lose by going into it, right? But at the end, I had amassed a decent amount of net worth. And I'm like, nothing good can come out of staying here longer, right? If I stack up more chips, my life wasn't going to change. But if I take a lot away, they might. And you never know when one of these overnight standard deviations are going to happen, like a September 11th. And I've been through a lot, and I was really good at managing risk and managing my money during that period. So I just decided it's time to exit. But what also happened during that period is that I was married now, and I had 2 kids, and I had one on the way. And I had people who relied on me, and it was very different. And so I was just kind of, I'd been down there since I was 19. I was 35 or 36 at the time, and I was tired, and I wanted to try something new. And the next stage was really managing my wealth, because up to that point, I had lived out of my trading account. I had made money. That's where I pulled money out of for living expenses. And I'm like, okay, now it's time to turn my assets into income, to grow them. And I've always had this, just this fear of losing money and going broke. And I think from a little kid, I've always been a saver. And you hear all these stories about people who have made it and then lost it. And unfortunately, there's a lot of tragic stories, especially from the Chicago Mercantile Exchange. It's sort of like pro athletes, right? Who make a lot of money when they're younger. They don't do the right things, and all of a sudden they squander it. They make bad investments. And I didn't want to be that person. So I really wanted to be proactive. And the reason why real estate is because I got introduced to it when I was 12, 13 years old. Those were my summer jobs with my grandfather. He was in real estate. But I also just loved sort of the simplicity of it and the investment, what it can do for your wealth, the passive tax efficient income, the ability to grow it, the simplicity around it. But unfortunately, when I invested in it passively, it was sort of 2 steps forward, 1 step back. Couldn't find, great partners with my money, to be good stewards. And sometimes, a couple of times, candidly, just got, punched in the face or brick wall. And that wasn't fun. And it was really, so I decided to go educate myself. And I went back and I got a master's in real estate at DePaul University. So just retooled. And I took 14 real estate classes. I developed a network. My partner and I got together too. I had known him for about 4 or 5 years. We had worked on a nonprofit together. We were really just like-minded about the way the world worked and believed that nobody would be better stewards of our money than us. He was already in real estate doing some stuff. And in 2007, we got together, and it was more like a family office, but we knew that we wanted to make it bigger than us. So even in 2007, we formed, at that time it was called Origin Capital. We've since switched the name to Origin Investments. But we knew we wanted to build something bigger beyond us. But at first, it was 2 guys buying real estate and just trying to buy the best deals they could for their money. And it started really working, and we were protecting ourselves. We were buying debt. We were finding good deals. And then in about 2009, we started inviting other people in, friends and family, high net worth individuals. When we find great deals, we'd syndicate it. And then our fund business started in 2000, late 10 is when we concepted it. We launched Fund 1 in 2011. And that was really an opportunistic fund, because that's what the environment was at that time. And we've just grown organically since then. But the whole thing that drove us and still drives us today is building that institutional platform for the individual investor. And what I mean by that is having an institutional quality team, people who really understand real estate, how we underwrite, evaluate deals, the PPM, all the terms in there, the fees, the client service. Because when you think about what an institution is able to command when they're putting 20, 30, 40, $50 million in a fund, it's very different than when somebody's putting in $100,000 or $200,000. And so it's always been our vision and our goal to create that platform for us, right? For people who are like us. And today, I'm happy to say we have 2,000 investment partners. We have more than 30 registered investment advisors who we work with. We have 3 funds that are open and active right now. We're launching another fund next month. And what we do, it's very simple, is we help high net worth investors grow their wealth and generate tax efficient passive income through real estate investments. And specifically, we build, buy, and lend multifamily real estate in what I'll call the smile state. So Tennessee is actually one of our states, and Pili, I know you're there. It's one of our favorite states, as a matter of fact, right now.
Mine too. Tennessee is one of my favorite states. I have so much to unpack right now. I love it. You just gave us basically the genesis of your real estate journey in all of, I think that was 5 minutes. So let's go back a little bit because I want to talk to your mindset, because you are at a place where a lot of my listeners want to be. They have grown up, wherever they started from, they're in real estate now, they are making a living now, and they want to go to that institutional level. They want to create that fund. But what separates you, because you said you basically started building yourself up at the Chicago Mercantile Exchange at 19 years old, and then you decided to become a trader. And then you've lived through September 11th. So what separates you? Because all I heard was growth throughout the entire time, from 19 till now. You grew and you knew how to protect yourself through these life changes, through these situational things that have happened to all of us. So September 11th happens, and you go through that. And then 2008 happens, and you went through that. So these little pinpoints of time periods that you've dropped, you have, what I've heard is that you actually found a way to grow through that. So let's start with September 11th. How were you able to secure and perhaps save yourself, and if you had investors at the time, and grow out of that into when you decided to leave your trading in 2005? So how did you, during that time period, how did you grow?
Yeah, I'll say one thing, kind of related to that, and this is at a very high level. I have I guess two things: a fear of failure, right? So I think I go the extra mile, and, I believe a lot of people have that. And it's not that I can't think of life on the other side, right? And so that has always been a driver, working hard, work ethic, but I don't have a fear of risk. And so a lot of people, like, that doesn't always correspond. And I don't know why, I don't know if I have but I always tell people, when I was a trader, I never thought about the money. And I just didn't. I just went in there making good trades and competing against others. And I didn't, when things got out of hand, I knew, like, I had to cut my losses and be done and start over and do it again. And it's like any business out there, whether, or investment strategy, it's the law of large numbers. And you're going to lose on some investments out there. But over the long run, if you make good choices over and over and over and over, you're going to do well, right? And part of the good choices is just risk management, diversification. Now, that was like 2001, and there were plenty of other large macro events that happened when I was trading that I could go through, but that was kind of the genesis. I was really good at keeping my position to a point where it never got away from me. And so that's, kind of what I carry into real estate, is just understanding the risk management side of it. And we have a saying, like, you only need to get rich once. And real estate is an investment strategy that is really great at keeping people wealthy and allowing them to maximize the benefits of their assets through the tax efficient private side. But candidly, I was out of the market, not for the most part. I mean, I had investments in the market, but some of it was a little bit of luck. When David and I started Origin in 2007, the cracks were already showing. And we were out there looking at deals, and nothing looked good. And we're like, that doesn't make sense. And suddenly it was more about people wanting rescue capital, because we're like, well, where do we want to position ourselves? And we're really learning, and we're trying to figure out where we wanted to play. Do we want to be in value add? Do we want to be in development? Do we want to be in the debt side? And to us, having money, we're like, well, you know what? Like, a nice stream of income makes sense for us. And so we were looking at the debt markets at that time, but everything was just kind of beginning to fall, right? And reading. And so out of that, though, we had this sort of aha moment in, I think it was 2008, probably along that time. And somebody came into our office looking for a loan. And what happened was his loan got sold, and it was I'll call it an $8 million face value on the loan. And somebody bought it for $3 million, and they wanted him to pay it off in, 6 weeks for $4 million. And we're like, well, that's where we want to be. We don't want to be, in this deal at $4 million. And our whole strategy just sort of shifted into buying debt. Well, that lasted a few years till the debt markets normalized. And then it sort of evolved into the value add space. So it's risk management is really something that is core to what I believe, my partner believes. And I always tell people it's not, a lot of the things, what you do doesn't define you, but what you don't do, right? And so we don't guarantee loans. We don't cross collateralize assets. We don't use a lot of debt. Everything we do is about 35% equity. And it's when you get into a crisis, you can't make those decisions. You only get one time to make the decision. And even in COVID, we didn't know what was going to happen in March and April and May and June, but we knew that we made some really good choices, that we were in growth cities, that we were in the right asset class, that we were in multifamily, that we used a lot of equity in our deals, that we had the right team behind us. And those are decisions that, we're like, we're good, right? We're going to be as good, if better, than anybody else. Now, at that time, we thought maybe we were going back into an 08, 09. We didn't know. And it was time to buckle up, and we made some decisions. But I would say that, you have to have the right strategy. A lot of people, they want to look at the upside, right? If things go right. Well, things do go wrong. And you have to decide, are you doing all the things that matter? Are you in the deal with the right people? And I would say that's the number one thing. And if things go wrong, are these the people who you want to be with, right? And I will say that in my lifetime, when I've justified the deal because it looks so great and I sort of didn't do enough due diligence on the sponsor, the person running it, that's where things have gone wrong for me. Not the deals. We're all investors. We understand macro environment risk, but it's all of a sudden when you have a bad actor, they'll find ways to be bad, even when the deal does well in good times and especially in bad.
You have made me breathe so much easier because you've taken the words right out of my mouth, folks. I've said this time and time again. You can have the best deal in the world. It could look spotless. But if the operator, if your sponsor, a bad sponsor, can take a good deal down, I would rather invest in people that know what they're doing, that have great track records, that are just good people. And I'm talking about the whole circle, that have the background that you have, Michael, that have tried and true evidence that they can do what they say that they're going to do. So thank you for mentioning that. And there's again, you are giving us so much information, Michael. Thank you so very much. Are you?
Well, Pili, if I can just add to that, we're David and I are still the largest investors at our company across our deals. And that's, alignment is everything when you're going into these, these opportunities. And I would tell anybody out there, the higher the IRR on a deal is, the faster you should run away from it, because that's, what I've seen out there is these high, like we've never played that game. And I have to tell you, it's been challenging, and it's been an internal dialogue when we're coming out and our fund says 9 to 11%, and you have competitors going, hey, we're going to get you 16 to 18, or we're going to do this, or people don't understand, how IRR actually operates, or multiple on invested capital. There's a lot of education that needs to go on, but it's couldn't agree more. It's people first. The last thing you should look at are the deal returns and the fees, right? If you don't see value in what the sponsor is bringing, right, and everything else, and you don't feel comfortable with them, don't look. But there's a bias to what we do. We're like, oh God, a 22% return. Well, if it goes wrong, I'll probably still get 12. Well, no, actually, those tend to be binomial,
It's crazy because I see these numbers on other people's deals, and I'm just like, how? I don't even know how you're going to be able to do that. But okay, if you trust that operator, let's run the numbers. And normally I can't even get to the same numbers. And I'm in this market, and let's talk a little bit about this market. Actually, before we go there, I actually want to reiterate why I asked you that question as to what we've been saying. It's your track record. And I wanted to know why you are the way you are, and why you have been able to navigate the waters that you have. And it's because you have a fear of failure, which is something a lot of us do, but you're different from me. I actually have a fear of risk. I am not risk tolerant. My husband is the one that has no fear of risk. I'm the one that pulls back first. I'm just like, ooh, that doesn't look good. But that combination has worked out for you because you've been able to navigate through these waters by making those smart decisions, by doing the things that you knew you needed to do based on the information that you saw, not what you are hoping for it to be in the future. Again, for those people that didn't hear me in the back, based on the information that you have. So like when you look at a deal, you base it on the information that you have. You don't base it on the future returns. Base it on the information that you have. So Michael, thank you for jumping into that and letting us dive into a little bit about why you are the person you are today and why you are somebody that somebody would want to put their hard-earned funds into. So thank you for that.
So wait a minute, can you repeat the question? I was listening.
So there was no question. I was just thanking you for going into your past and letting us know a little bit about what makes a good sponsor and why Origin
thank you.
Is a good
thank
place
you,
to
Pili.
be.
Sorry, I thought there was and I'll just add, we're all, so many of us are doing the same thing. And if you're an investor out there and you're looking at deals, and we're doing a ground up development deal and another sponsor is doing a ground up development deal, and you're looking at 10 of these, well, they all kind of should cluster around the same types of returns. But if you have an outlier, you really have to question that, right? How are they underwriting? How are they doing things? And we've always adhered to institutional standards when it comes to underwriting. And all that means is that, like, I look at risk. Trust me, when I say that I'm willing to take calculated risk. But when we are at our credit committee meetings, I dial into all the areas where we can lose money, right? And if all of those can be solved, right, to a reasonable degree, and you've eliminated all the objections, then, like, you have no choice left but to say, okay, like, it's good real estate. I trust our team. They've done a great job underwriting it. We stress tested it. But, at some point, if you want to make more than 2% on your money, you have to take risk, right? There's no such thing as a free lunch in investing. But that's also why we have just a prolific deal funnel, and we'll look at, more than 500 to 1,000 deals a year, so we can get down to those 12 to 15 that we might buy, right? And looking at that universe and understanding those risk-adjusted returns across different cities, across different assets, across the capital structure, I think that gives us a distinct advantage. And that's just how my partner and I have set the firm up, because we don't want to be beholden to even one strategy. We want to be able to be tactical. So in today's market, we're not doing anything in the value add sector because value add to us doesn't make sense logically. Value add is trading an existing project that's 10 to 15 years old is actually trading above replacement cost. And then when you put $10,000 or $15,000 per unit in it, and then you have to assume that you're going to get a premium on top of all that, well, now you're $50,000 above today's replacement cost. Basis matters. We don't want to be there. We're building and we're lending in today's market. And those are the only two things. And if the market continues to go our way, building, the margins are only going to be that much better. And lending is just a way to protect our money.
So tell me a little bit about what you're offering to investors right now. You said you have a prolific deal funnel, which is not something that I hear quite often, because normally I have to question that, because a lot of the people I've talked to, they say, deals are kind of hard to come by. They're having a hard time getting deals. They're having a hard time, ... fill in the blank.
Yeah.
How are you able to source deals? And how are you able to help more investors that way?
We're not doing anything in that middle bucket that I talked about, build, buy, or lend. And there are exceptions to the rule. And candidly, we haven't looked at a value add deal in over a year and a half, 18, 20 months. We do have one on the table, very interesting deal. It was tied up by a sponsor 6 months ago. It is a deal that is being bought out at certificate of occupancy. So it's a ground up development. And that's one that we can't ignore, because it looks like we're getting about a $25,000 per unit edge in something like that. So I absolutely agree that deals are very, very difficult to find out there, if not impossible for us. So where we've decided to focus is in the ground up side. And the ground up side gives us a distinct advantage. First of all, entering markets. You're in Tennessee, you know how hot it is down there. If we wanted to go down and start competing for deals that were core plus and value add, you're going to get 25 people at the table. And that project is going to get bid up to points that just don't make sense anymore. And it doesn't. This is why we're going into ground up development, though, because we're working with sponsors, we're helping them with general partner capital, taking down land, doing a lot of things, but getting in to the funnel much earlier and upstream. So we have this pipeline of opportunities. And to us, our funds are more buy, fix, and hold rather than buy, fix, and sell. So the ground up opportunities are more of a build to core. And it's a better way for us to get into a market like Tennessee, Austin, Phoenix, places like that, where prices have just gone out of control. Right now, we have more than 3,000 units under construction. So when I talk about, prolific deal flow, it's almost entirely in the ground up development side. But the other side of the equation is our preferred equity program. And oftentimes, if we're still out there, we're actively looking at deals, core plus, value add deals. And if we can't make the numbers work, a lot of sponsors will come to us asking us for debt, preferred equity, to bring the leverage up from 65 to 80%. Could be on a development, it could be on a stable kind of a value add deal. So those two ends of the spectrum is what we're looking at right now, and it's a barbell approach today. And until we find more normalization in the market, this is going to be the future.
Fantastic. Michael, thank you so much for joining me today. Before I let you go, two more questions. How can people find you? Let's start off with that one. How can people find you if they want to know more about you and more about how to invest in you?
OriginInvestments.com. Go there. And you can connect with any of us right on the website. So we actually have a chat box. We make it super easy. But more importantly, if you want to peruse our offerings, you can fill out a simple form. You can download a deck on any of our opportunities out there, and you can connect with somebody directly in our investor relations department as well.
Fantastic. And then for all of my investors that are listening to this today, whether or not you are investing passively or you're a sponsor, what is some crucial advice that you can give to some of my listeners as they're jumping into their real estate journeys or as they're trying to level up as you did in their journey?
We touched on this a little bit, and I think there's two different people there to talk about. And the first is, if you're going into this as a business and you really want to build something like we've built, right? You're going to, you have to figure out what is your differentiator? Why do you exist? What are you going to do better out there? And that's, for a lot of people, that's challenging, right? Well, why? But every company has to ask that same question. Surround yourself with great people, work smart, and find a niche out there and do something. And I would say that if you're a passive investor, on the other hand, it's about people. Spend your time finding the right people. All too often, I think, especially for those who are doing individual deals and they're spreading themselves out amongst, multiple sponsors. Well, I think in reality, what you're doing is you're creating more risk, right? You might be diversified across assets and investments, but you're also increasing your risk that one or two or three of those sponsors might not be people who you want to do business with. And you're going to find out eventually, because no tree grows to the sky. And, multifamily is really having its day in the sun right now. And that'll slow down, it won't forever. I don't think, if it does, it won't last for a long time, but it's people. And that's what you really need to focus on out there, is vet the managers, vet their track record, their team, their balance sheet, and whatever you can do just to figure out what kind of people they are, right?
I love it. Vet the person. You need to invest in people before you invest in a deal. We did speak about that before, but that is something that it goes across all business. It goes across all aspects of life. It's a people business. It's a people world. So invest in people, not deals. Michael?
Yeah, the best line I ever heard was, problems walk on 2 feet.
Yes, they do. Yes,
So
they
true.
do. Problems do walk on 2 feet. The buildings don't walk themselves. The buildings don't fall apart on themselves. It's the people that walk them. So Michael, thank you so very much for coming on the show. I am so grateful for you.
Pili, thank you so much for having me.
You're very welcome. And to all of my listeners out there, If you loved what you heard, please rate, review, and subscribe. It would mean the world to me. And then go check Michael out over at Origin Investments. It sounds like he has a great team, and he would like to get to know you better as well. So thank you again. Grateful to you. Aloha.